Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his favorite guest of the week, Anna Kelly. How you doing, Anna?
I'm great. Great to be here.
Hey, so I have a question for you. You obviously have been a part of syndications, both as a limited partner and a general partner, right? That is
Yeah.
something I have not done on either side, right? To date, I've ignored them. It's like, hey, this is our money. We're going to do our thing in our little piece of the world. But I've been an accredited investor for a decade. So, and I'm on lots of lists. So I get lots of people sending me deals. And really what I do with that is I'm just trying to figure out what's going on, right? More
Right.
information tells me what's going on. So I've
Yes.
been nervous about that space for a while. We've talked about it. I've seen some wacky assumptions. I've seen really bad debt structures. To me, a
Mhm.
lot of the syndication deals done today remind me of the '08 sins in housing, right?
Yes.
Short-term debt, unrealistic expectations, all of those things. So I've told lots
Yeah.
of people not touching most deals. However, I just saw something the other day that literally stopped me. There is a syndicator out there, well known, who is celebrating buying Class A, top-notch stuff, blah, 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 Park Place and Boardwalk for the Monopoly board fans at a 3.5 cap, which again, I don't know anything about it. Whatever, record occupancy, all that stuff, fine. What scared me to death, he said he expects the cap rate to go to 2.75. So he admits to paying above market because again, he outbid BlackRock. He outbid Goldman Sachs. He outbid insurance companies. He was the high bidder and happy to do it. And he's telling folks his expectation is to go to 2.75. So Anna, I'm going to stop there because I did some math on deals, but I just want to stop there. Would you ever, I can't imagine it's a good practice to tell people you expect cap rates to fall, especially when they're already this low. Is that crazy or am I just missing the boat?
Oh, it's crazy.
Okay,
It's
good.
crazy. So a couple of things to your point. I do think, and I study this a lot because I do multifamily,
Yeah.
right? My own deals, I got to know. My joint ventures, I got to know. My syndicators, where I've got a lot of investors, I'm not going to lose money. First rule is do not lose money. Protect your investors' money. If I'm going to protect my investors' money, I got to get pretty good at predicting what could go wrong. How do I mitigate? Let's think about the worst case, underwrite the worst case, be conservative, and then everything else above that is gravy. That's
Right.
how I operate. Most syndications that I see, because again, I'm an LP too, so I can't GP every deal. If I found amazing deals, I'd never LP, right? But it's a tough market. So I LP and I invest in other people's deals. I'm not kidding. 90% of them I wouldn't touch because they're so aggressively underwritten.
Yeah.
It's investing on hopium. And here's what's happened. You mentioned something, and this is exactly what's happening. You're in an area where there's fear in the marketplace. There's inflation, and investors are looking for alternative and a safe place to park their cash, not have it eaten away by inflation. Multifamily real estate and other commercial has historically been a preservation of capital play when fear in the marketplace is coming. So they go, I don't know what's going to happen. The stock market might crash. I could lose 20%. Inflation could go up 10%. I'm essentially losing 10%. So let me buy an asset that historically goes up in value, even slowly during recessions and above, in a market that there's more, demand than supply. And they think, let me make 2 or 3 or 4% on my money. And at least I'm doing better than the alternative, the risk adjusted returns. So these companies like BlackRock, for example, big banks, big insurance companies, they're coming and trying to scoop these up, and they're trying to buy it for a preservation of capital play. So they'll pay 3.5%.
Yeah.
Right?
Yeah.
The problem is when syndicators like me, and I don't do this, but syndicators that are individuals, small businesses, way not a BlackRock yet.
Yeah.
We might have a fund, but we're not a BlackRock. We're independent operators.
Sure.
When we're trying to buy an asset where we need to pay our investors a 6 or 7 or 8% cash on cash return, because that's what they demand and that's what they've been used to for the last 10 years. And we need to show that the IRR is going to be at least double digits because there's risk involved in multifamily, right?
For sure.
Then I've got to do some things to be able to show that I can reach those numbers. And all those things have to go well. In a rising market, I can control rents are probably going up. If there's not enough, supply, I can make a unit really nice. I can raise the rents. And I know that because values are going up, cap rates are probably going to at least stay the same or get better. And I can predict fairly well what my property is going to be worth. But what's happening now is these individual syndicators are trying to compete with the BlackRocks and the Grant Cardones and the insurance companies and all of this. So they're way overpaying.
Yeah.
And what happens, Michael, is because they can only get a loan based on a stabilized property at its current net operating income. In order to way overpay, you can't get a traditional loan. You've got to go bridge debt, which is short-term money, higher rates. They depend on a refi. And what they're hoping is that when they refi, rates will be about the same as where they are today. And they can definitely execute their capital improvement plan at the cost that they're anticipating. Never mind that we're in inflation. They can force rents to the top of the market. Never mind that there might be an affordability issue and that cap rates are going to keep going down. But if any of those factors don't go well, they're not only not going to be able to pay their 6%, but they may be negative and have to have capital calls. And so there's so much risk right now. You can't control expenses on construction. You can't control your timeline on construction because there's a work shortage and people want more money. You can't control where interest rates are going. And you can't hope that cap rates just keep coming down. When you do all those things, which all have to happen for you to beat out BlackRock on your purchase price, you inject tremendous amount of risk for that average 6, 7, 8% cash on cash, 14% IRR. It's really not a wise thing to do. So I don't do deals like that.
Yeah.
I syndicate, but I have found 2 in 2 years that are de-risked, really great deals because we got them off market.
Yeah. Yeah. It's again, to me, again, I don't play in this space, but I can do math, right?
Yeah.
I know how the formulas work. And I think anytime you are paying top of market and you're celebrating overpaying, right? When you're outbidding BlackRock, who again probably writes a check, they don't even have debt. So cap rate to them is the true cap rate. No mortgage needed, no bridge debt needed. That you're at top of market. That's And then the plan is for everything to go right and cap rate. Cap rates have to have an artificial floor somewhere. Right. I did some research because again, I'm going like, have cap rates ever been lower? So Beverly Hills, California, there have been a couple of deals transacted in Beverly Hills, California at a 2.2 cap.
Yes.
Okay. So there's some special places where I didn't know that was possible. Right. So I did find a couple of cap rate deals closed at 2.2.
Yeah.
But come on, buying a deal at 3.5, expecting cap rates to fall to 2.75. That seems foolish, especially given episode 2 or 3 we did where rates are going to go up a point in the next 12 months. I mean, at some point, just go get a treasury.
Right. Absolutely. And, I will say this, people focus a little too much on cap rates because with commercial real estate, I'm not betting on just slow appreciation with the market. I do have the ability to come in and force that appreciation. So in a class A building, like whoever you're talking about, in a class A building, you're not going to be able to force rents significantly because assumably if it's a great property in a great area, the rents are already kind of where they need to be.
Yeah, you're not getting B rents in an A area, right?
No. So maybe they're hoping that, hey, this rent increases of 5-10% this last 2 years, they're going to keep going for the next couple of years. I don't think that's going to happen in class A areas, especially if rates change. But so to me, that's unwise. If you have debt on the property and investors and expect a better return, buy a lower cap rate, not rise. But full disclosure, I just bought a 20 unit for my own family, no investors. We bought it. I bought it at like a 3.4 cap.
Okay.
But here's the thing, 3.4 cap on current rents that had not been raised in 23 years. 23 years. So
so rents are up a little bit in 23 years.
So rents were $495, $520, a few at $675. Market rent as is, no repairs, is $1,200 all day long. $1,200 all day long. So I can buy that deal at a 3.5, but I'm assuming that when I want to sell it, it's a 6.5 cap. I'm not going, well, I bought it at a 3.5. I'll sell it at a 2.5. if the cap rate today is 6.5 cap on a stabilized property at market rent, then yes, I can say if things are a bit still painful, cap rates might still come down as a preservation of capital play, but I'm not banking on that.
Mm-hmm.
I underwrite an increase of 0.1% per year minimum, which is in a 5-year hold, cap rates go up 0.5 point.
Mm-hmm.
10-year hold, they go up 0.1. Because historically, cap rates haven't moved more than about 1% in a 10-year period, no matter how high or how low the economy's been. So just, invest conservatively. If you see these deals and they need all these things to go right in order for you to make your returns, just say no, it's not wise. Invest with operators who are being conservative, assuming the worst and saying, here's how I mitigate it. And if I can do better than that, then you're going to be a really happy investor.
Yeah, just to close on this topic. So I did some math the other day on it. I had to assume numbers, right? So I assumed 500 grand of NOI or net operating income at 3.5 and then at 2.75. Essentially the building goes up like $3 million, something like that. And then I said, what happens if they go from 3.5 to 4.5? Then the building goes down. I think it was like 4.5 million. But why is that important? Well, when you got to refi the short-term debt, your LPs are gone.
Yes.
All the equity of the LP is gone. And you have to come up with another $2.5 million or something to get another loan or sell the building. So there's a lot of LP, again, as I said in that video, there's a lot of LPs investing with hopium. I like that word, that already lost their money and they just don't know it.
Right. It's really scary. And, if people are doing bad deals on paper already, they're doing it to get the acquisition fee and to pay their employees that they've not been able to find deals for a year or two. We got to get something done. We got to give our investors something. That's never the wise way to do things. You do great deals in every market, but you may do fewer of those deals. And so just you have to always be thinking about risk. And this is where my mind is so much right now. I'm hammering to students. We hammer it. I hammer it to my investors is every time you're investing in anything, it's not about the return. It's about what's the risks involved in order to get that return. And if I can invest in something low risk and make 6% cash on cash, or really risky to make 6% cash on cash, I'm going to invest in the low risk thing. Mm-hmm. And even if I make less of a return, I'm going for the low risk. This is a time to protect and preserve your capital.
Amen.
Slowly grow your income, slowly grow your wealth. If it sounds too good to be true, it probably is.
There you go. Well, Anna, how can people find you, get part of your world, and see what kind of deals you're working on?
Great. So you can find me at reimom.com. You can also find me at greaterpurposecapital.com for our syndication opportunities for accredited investors looking to invest in deals that we make a meaningful impact in the lives of our investors.
That's awesome. Go do yourself a favor. Go check it out. Anna, thank you very much for these conversations today. You have a wonderful day.
Thanks so much. You too.
Thanks.